Hey guys, it's Dan. This is a third and final video, I think, for the night. It's about 5:30 on Tuesday, the 4th of September. Consider this a combination of teaching and a trade if you want it. So I told you guys that I was looking at which is big lots for a naked put. And the naked put that I want to do is a January expiration $35 put, and it pays 78 cents. So that's good. Sorry, I'm getting mugged by my dog. When he wants my attention, he sticks his nose in my mouth. Literally. It's very strange. Sorry, guys. So, for a minute, I'm going to make this go away, okay? Just bye-bye. Now, so this is a naked put. It's great. Now, why do I like it? We got to look at the chart to understand why I like it. I like it because the stock fairly briefly ran down to about 36 some time ago. I guess that was May or June. And then other than that, it has not been below 35 and since it's been 5 years. So you have a stock that got an earnings surprise and it got its butt kicked. So at 35, I feel really good, and we're getting paid more for this option than we normally would for being this far from the money. If the stock ran back up to 50, this $35 option wouldn't pay. I believe this gap will close, and we've got so much time for that to happen. Okay, so keep that in mind. So that's a naked put. That's what I'm going to do. And I'm going to do probably 5 contracts on that one. Because remember I told you I like my average gain to be about 400 bucks. So 5 contracts does that for me. Ish. Okay, so let's say you go, oh, I like that. I buy that theory. This is a great way to understand spread trades. And I started thinking, okay, well, what about the people that can't take them? You know, I don't want to keep dangling these carrots in front of people. But the fact is, you can. But when you look at them, they look scary unless you understand what's happening here. What's happening here, as you know, the whole end game when we sell a put is to keep the premium, 78 cents. Long as the stock stays above $35, and we'll never hold this till January. We'll probably be out of this in 3 to 4 weeks once we start getting some movement and time decays. So, but you would need $3,500 per contract. Sorry, 20% of that. You need $700 per contract in your account to do this trade. I guess that's not too bad. We've done spread trades that bad. And you have to be prepared that you might end up with the shares. Again, I'll take big lot shares at $35 all day long. But not everybody's in a position to be able to do that or say that, or you probably are, but you just don't have it in your trading account yet. Okay, so $35, that's a magic number. Now, what if you said, I don't want to do a naked call put, or I can't do a naked put? Here's what we do. Remember, keeping in mind, the end game is only to make money off this put. That's all we're trying to do. So what we do is we have to buy a very cheap insurance policy. And the further we get from the money, the cheaper that insurance gets. So let's look at this for a second. If I go to 32.50, I'm paying 38 cents insurance, which means instead of making 78 on the trade, I make 40 because 38 is going to the insurance company. I bought this put. I hope I never use it, but I have it. So I say, well, I don't want to pay that much for insurance. So I go down to 30. At $30, now my insurance is costing me only 23 cents, and my net trade is $55. To me, that's still expensive insurance when all I really wanted to do was a naked put. If all I really wanted to do is a naked put, I would want to pay as little for this as possible. I hope this is making sense. So I could go down to $27.50. Now I'm paying a dime. A dime seems reasonable. A dime is as close as you can get to doing a naked put as I am. I'm going to make 78 cents per contract. You're going to make 68 cents per contract, as long as the stock stays above $35. So if you buy that theory and you don't want to do a naked call, then here's a cheap insurance policy. You pay 10 cents. So you understand that, I think, now. Instead of keeping 78, you keep 68. Hence the gain here. The max loss, however, grows because the spread between the two is wider. I know it's difficult, but it's you don't really want to look at these max losses. I mean, it's not that you shouldn't, but if you believed that the stock was going to fall below 35, you wouldn't do this trade anyway. You would just say, Dad, I'm going to pass on this one. And of course, you always have that right. Now, interestingly enough, by buying this cheap insurance policy, we've actually moved our break even down to 34, 32. Move that down here about, let's see, there, close enough. And we have an 88% probability on this trade. So it's actually a higher probability than just the plain old naked put. But again, these numbers are off of a stock that just fell like $10, I think, and you know that that's not sustainable. You know what comes down must go up. So let's look at the chart one more time. I thought I had my drawings on this one, but I don't. So here's what happened. We just had a gigantic gap down, I'm sorry, stock didn't fall 10. Well, it's fallen almost 10 from the top. It started at 50 and it's fallen to about 42. So, and this earnings came in right in here, so that caused the gap down. So I do believe we'll work our way up to the gap. Sorry for the long video. I hope this makes sense. So in all of this, in my opinion, there's a trade here. For sure, I'm going to do a naked put, and I wanted to explain to you what you could do if you wanted to join in on this trade and have some insurance. Okay, I hope this makes sense. Thanks. Bye.